Hi, welcome to the Interaxis YouTube channel and Interaxis.io. We want to talk about fund management because there are a lot of exciting things going on in the decentralized world within fund management, portfolio management and such. But in order to do that, as with a lot of these videos, we have to move back into the traditional finance world and show how fund management and investment management has kind of evolved to this point, show you where we are, and then we can talk about some of the exciting things. So here, we're going to be more on the traditional side. So let's say I am the investor here. Okay, and by the investor, I mean just anybody who has money inside of a brokerage account, inside of a retirement plan, anything like that. In that respect, I am the investor. Here in the past and now are all the options. Here's all the things I can do with my money. Okay, I can decide to invest in stocks, bonds, whatever else it might be, right? I can go to a brokerage account or whatever, and I can choose the stocks. I can choose these investments. I can research them. I can decide how much of my money to allocate. I can allocate it now. I can allocate later. I can buy. I can sell, right? And I'm probably going to pay a trading fee, right? Every time I trade, I'm going to pay some sort of commission to whoever the broker is, and that's going to be my fees, but I'm doing it myself, right? And I'm picking individual stocks, bonds, whatever else they might be. Now, what happened at a point is the people who are really good at picking stocks decided, hey, I should just do that for a living, and they created mutual funds, okay? And a mutual fund is essentially a fund. It's a group of people. Everyone can buy in. It's what's called an open-ended fund. And the mutual fund, or the fund managers, choose which stocks or bonds or assets or whatever they're going to put in the fund, right? So they then take this money coming in from here and they allocate it among all these different stocks, bonds, etc. Okay, and so what happens is by virtue of the fact that I'm a part owner of this mutual fund, I'm kind of a part owner of all the holdings within the mutual fund. Right, so as these are being traded, as they buy or sell Apple stock or as they buy or sell bonds, that actually technically triggers a taxable event for me as the owner of this mutual fund. Another interesting point about mutual funds is you only really know the value, and you really only buy or sell it at the end of the trading day. Okay, a mutual fund's value is based on adding up the value of all the holdings and dividing by the number of shares, number of shareholders, or the number of shares. At the end of the day, you add all these up, you divide by the number of shares, that's the value that day of the mutual fund. A mutual fund is also not traded on an exchange. I either buy it or sell it. I buy it essentially from the mutual fund company, or I redeem it. Redeem it means I basically take my money out. There's not a buying and selling necessarily of a mutual fund technically. Again, as they buy and sell the holdings within the fund, it might or might not trigger taxable events for me. But a mutual fund is good because it means that someone else, some fund manager, is actually doing the research. They usually have a team, they have a policy statement and everything, and they're doing the research, and they're investing in equities, bonds, somewhere, in this country or the world, and they all have a different policy statement. So it might be large cap growth, which means we're going to invest in large companies with the potential to grow, or an income fund or an international fund or something. And they get fees. They charge an annual fee pretty much based on what their expenses are. So as the mutual funds get bigger and bigger and bigger and more money comes in, the fee for me as the owner might go down, because if they have a team of 15 people, or their team of 15 people at the mutual fund, they might not have to increase that to 16 and 17 and 18 people just because they got more money in the door. So you get these economies of scale. Once they're really good at it and they become really, really large funds, the fee as a percentage of my holdings actually goes down. So that's a little bit about mutual funds. Eventually what happened was people said, well, these mutual funds go up and down. I have some taxable events. I kind of just want to track the Dow index, or the S&P 500 index, or the Russell 2000 index. And so you had the advent of index funds. Okay, index funds Kind of do the same thing as mutual funds. The difference is they might just track an index. So you have the S&P 500, you have the Dow index, right? Now, they essentially work like a mutual fund, except that with the index fund, the fees, the cost, the expense is so far down because really, you just have to look and see, if I have an S&P 500 index fund, I just have to look and see all the stocks in the S&P 500, what their weight is, how much of them, with a percentage within the S&P 500, and just buy that and hold it in the fund until such time as the S&P 500 decides to drop a particular fund, in which case I sell that one and I buy whatever they put into the index, right? So I don't have to have a team of 15 or 20 people. I don't have to do a whole lot of research. I literally just have to look at a list of the S&P 500 and determine what to put in there. Now there's marketing and everything else involved in it, but the nice thing is the fees have come way down and it is literally tracking the index. If the S&P 500 goes up 1% today, my index fund goes up 1%. It's very simple. So then beyond that, you have what's called ETF, or an exchange traded fund. Now this is kind of a tough concept to grasp. An exchange traded fund is very much like a mutual fund, right? An exchange traded fund has an investment policy statement. They have an idea of what they want to do. So there might be an S&P ETF, there might be a growth ETF, there might be an international ETF. There have been 2x and 3x leveraged ETFs, okay, and it's an exchange traded fund. So the ETF has these holdings, right? So they might have the same holdings as a mutual fund, and very often they do have the same holdings as a mutual fund. The difference is the value of this ETF is treated like a stock. Okay, this technically can move independently of this. It is not, we don't at the end of the day add up the value of everything in the ETF and divide by the number of shareholders and that's the value. This value can go up and it can go down on its own. And therefore it can be traded at any point. What it also means is in any movement, any buys and sells of these particular stocks do not necessarily trigger a taxable event for me. I own the ETF, I don't own these individual holdings in here. So it's kind of like I've invested in this company and I've told the managers, you guys do what you need to do within the company. At the end of the day, if you've made a profit, you pass some of that on to me or the value of the ETF goes up. That's how an ETF works. And in a lot of cases, they've actually brought a lot of the costs down of the ETFs as opposed to the mutual funds because there's less administration, there's a wide array of distribution for them, there's a lot of information on them, so ETFs have become very popular as a way of either active or very passive management. And passive just kind of means I'm going to put my money out there and let it go, and I'll look at it in a few years or something. So that's ETFs have become very popular as opposed to mutual funds. So these are all the things I can do with my money. Okay, I can get a E-Trade or Schwab or Fidelity account, Robinhood, whatever I want to do, and I can start buying and selling these myself. I have to do the research. I have to make the decisions on when to buy, when to sell, how much, and everything. Alternatively, what I can do is I can put my money with a money manager. And a money manager, investment manager, whatever it might be, might charge me 1% to 1.5% of whatever I put in. So if I put $100,000 with this money manager, he might charge me $1,000 per year. This is an annual amount. And then he's going to make the decisions on what to do with my money. And he might say, look, we do all ETFs to keep your costs down, because what happens is any expenses that are borne by investing in these, whether they're trading charges usually or other expenses that come with investing in these, get passed on to me. So I might pay 1 or 1.5% plus whatever additional fees are here, but the money manager might say, look, we use a passive approach, or we manage using only ETFs or ETF and index funds. And then what they do is they understand what my investment policy statement is. And that's, how do I want to invest? How risky am I? What are my goals? What are my needs and everything? And they create my investment policy statement and they say, look, you're going to be moderate or aggressive or whatever it might be. And they manage according to that. and they probably have some portfolios and some algorithms and everything, and they decide how they're going to manage my money, and they get paid their 1 or 1.5%, and I pay that 1.5% plus whatever other fees. Now, recently, we've had something called Robo-advisors. And Robo-advisors is essentially a money manager, but it's done with code. So they take everything that the money manager would do, they understand what my investment policy statement is, they fit me into a little category, and they say, okay, we're just going to make these trades, but we're going to do it programmatically. We're going to get into the exchanges, everything can be done digitally, we're going to buy and sell as needed to reallocate your portfolio, to reallocate your investments, but we're going to do it using code. We don't have to have a lot of people, and therefore we can bring the costs way down. So maybe you have like 35 basis points. Okay, and this might be something like Wealthfront or Betterment or Personal Capital or one of those where they have these robo-advisors. You pay a little bit, you answer some questions, and they can just manage your money accordingly, and they do it all via algorithm. Okay, so those are my options for most investors. Now, if I'm an accredited investor, I have more options, right? Because if I'm accredited, I can go private, which means private is in the world of potentially private equity. It's in the world of real estate or real estate investments trust, BDC, business development companies. And what they're doing is I'm saying, here's my money. You guys go do what you do. If you're a REIT, if you're a real estate investment trust, you go buy a certain type of real estate. Here's my money. It's usually locked up for a pretty long period of time, for years at a time. But if I'm accredited, if I have a lot of wealth, I can afford that, right? I don't need that liquidity. But I usually will get a better return or a more stable return or something like that, because these people are just going to buy real estate. If it's private equity, they're going to buy a certain type of company a lot of times and manage that company. So they're essentially just buying cash flows or buying companies that already exist. A BDC or a business development company might go out and they might buy loans, or they might provide loans, or they might invest internationally or something, but it's only open to accredited investors, which means I have to have a certain level of income and or net worth to qualify. And even above that is we've all heard of the hedge fund. Now the hedge fund is usually for what's called qualified investors, which is a step above private investors in terms of levels of wealth and income. And with a hedge fund, my money is pretty much locked up as long as they want to keep my money locked up to do what they're going to do. And the hedge fund is where they can actually charge not only a management fee, like a 1 or a 2% management fee, but they have something called usually 2 and 20, which is they get 2% fees and 20% of any growth, right? And a hedge fund for qualified investors, that's the only place where they can actually get a fee based on performance. They can get a performance fee. Now, I tell you all this to go back into what's happening with the decentralized fund management, to say, especially in the private and hedge world, but if I'm going to create a mutual fund or a ETF or anything like that, it's expensive. Right? It's not a cheap process. There's a lot of marketing to be done. It's expensive to raise a lot of money. I know people who've tried to start hedge funds and try to start some of these funds, and they end up having to shut down because they just can't raise enough money to warrant all their costs. There's a lot of reporting requirements. There's a lot of communication that has to go on with investors. There's just a lot of things to keep up with, a lot of administration, and it just gets expensive. It gets hard. There's not probably quite enough transparency as people would like, and they really have to have great performance to warrant the potential lack of transparency and to warrant the lack of liquidity and everything else. So what you have is really good investment managers, potentially really good managers that are just not able to start a fund because in order to overcome a lot of those expenses, they have to raise a whole lot of money. And they might not have access to the distribution. They might not have access to the people that have all that money to raise it. And if they do have access, it might take them a while, or it might cost them a lot. They might have to do road shows and everything else. They can't just, put out a web banner or something and say, everyone come, all qualified investors come invest in my hedge fund. They really have to go find them, and they have to make sure that they find people that really like what they are doing. Unless they already have a lot of contacts, or they're already very wealthy, or they've already done this before, in which case they can probably say, hey, I have a hedge fund, and everyone's going to throw money at them. But a lot of really good investment managers from around the world are not able to necessarily start their own fund, or they try to start their own fund and they really don't get going and they really don't get to grow because they don't have the access to the distribution and their expenses are too high. So they can't raise enough money to charge enough fees to offset their costs, and eventually they just go, you know what, I can make more money just going to work for another fund manager. So that's where we are right now in the traditional world. The next video is going to talk about where we're going in the decentralized world and some of the exciting things that are happening. So please don't forget to subscribe to the channel here. Don't forget to hit us on our website, interaxis.io, and find us on Twitter at interaxis8. We'll see you in the next video.